Good afternoon, everyone. This is Maddie Heckman with IMN, and I'd like to thank you for joining us for our next panel discussion, Post-Covid-19 Home Values and Valuation. Are we at the top of the market? What information do you use to tell? We have a wonderful group of experts lined up to address this topic, and I'd like to thank them all for joining us. A few housekeeping items before I introduce our session moderator. Please feel free to submit questions throughout the webinar using the Q&A button at the bottom of the screen. You can upvote questions from others, and popular questions will be prioritized. Without any further ado, I'd like to hand things over to Deanne O'Donovan, who will be moderating the discussion. Thank you so much, Deanne.
Hi, great to be here with you today. We've got a really terrific group, so I think we're going to have some great conversation. I'm going to introduce everybody, and if you could all say hello, and then we'll get right into the questions because I know we have a lot of material to cover today. So with us today as panelists, we have John Brennan, who is the Chief Appraiser for Clear Capital. Welcome, John.
Thanks, Deanne. Glad to be here.
We also have Nick Shah, who is the CEO of Home LLC.
Hi, Deanne. Hey, everyone.
Hey, Nick. And we have Lev Pravda, who is an associate at Credit Suisse.
Thanks, Deanne.
And Marie Michaels, who is a portfolio manager with Lowe's.
Thank you for having me.
Great to have you with us today. So we're going to kick it off with a round robin and get a number of perspectives on our first question. So to kick off, let's talk a little bit about trends in the housing market. What are each of you seeing in your particular lines of business or particular geographies that you think are relevant for our market in 2020? John, let's start with you.
Yeah, sure. Thanks, Deanne. I think one of the things that we've learned a lot of lessons through COVID. And I think that one of the things we learned is that it seems to be a time where people have kind of reevaluated what their home means to them and in their lifestyle. And so kind of along those lines, we see that that a lot of people have kind of entrenched into their homes, made it more, the work from home certainly is a big part of that. Not necessarily commuting into an office because of the pandemic. So there's been more home offices. Along those lines, there has been what we have seen a tremendous increase in accessory dwelling units, ADUs. We've seen not only the marketplace look for it, but we've seen the regulatory world in terms of the government permitting process, as well as financial aspects being opened up to really encourage people to look at, maybe adding an ADU instead of necessarily going to a move up to a larger home. So we've seen that there seems to be, in the markets that we've looked at, there seems to be a great, particularly where I'm in California, we've noticed a lot of that in California, particularly where there are lots that have the room to add, let's say, an external ADU.
Thank you for that. Nick, how about you?
Yeah, I agree with everything John said. That every city in the housing market is hot. Like the Bay Area is hot, New York's hot, Austin's red hot, Boise is, jalapeno hot. Everything's super hot, and a lot of smaller cities are seeing competitive bids for homes, similar to what jumbo markets have been seeing for years now, and we expect that to continue. On top of that, to John's points, accessory dwelling units or ADUs are here to stay, especially in places like California where supply is so constrained. And, homes like in the Bay Area, homes are priced between $600 to $1,200 per square feet versus building an ADU only costs about $200 to $400, and it can be done very quickly with a lot of startups helping you through the way. So that trend is only going to increase. The ROI is clearly there, plus the potential of rental income and the possibility of an office. Overall, I think that US residential real estate as an asset class is absorbing offices and retail to an extent within itself. Your home is now your office, as well as your Amazon, Shopify is now your retailer. Someone will bring it to you. So it's US residential real estate has had a phenomenal 2020 and a continuously phenomenal 2021, and we expect that to continue for the next few years.
Thanks, Nick. So as we go to Lev and Marie for their take on this question, we did get a comment on our Q&A, ADU with storage containers, which I've heard a little bit about, but if either of you have any experience in your segments with that, feel free to chime in there. With that, Marie, let's go to you next. I know you're in New York and they've seen a lot of changes in the housing market.
Yes, sure. So I am New York metro based. With the onset of the pandemic, there was and there continues to be an exodus to the suburbs. And that's really driven by that need for the additional bedroom that multifam in Manhattan and the other boroughs does not offer. So there's been a grab for primarily luxury suburban homes in New Jersey, in Fairfield County, Connecticut, on Long Island, and regions also typically that would have never been really considered as commutable into New York City, and that includes upstate New York and even the Princeton region in New Jersey. As far as ADUs, containers, probably a little beyond my scope, but if the numbers work, then, and if local municipalities allow it, that could become a thing, sure.
Thanks, Marie. Lev, your thoughts?
Yeah, sure. So just to echo what Marie was saying, we're seeing similar trends with a huge uptick in HPA, especially in properties that have 3 or more bedrooms. This is being seen not only in suburban areas, but as Marie mentioned, areas that we typically do not see. One of the largest increases in HPA we saw outside of New York was in the Hudson Valley Catskills area in Kingston. So these are markets that traditionally have not seen large increases in HPA year over year, but in 2020, especially in the 3+ bedroom segment, we've really seen that as people begin to settle into work from home or even more flexible arrangements where they're not expecting to make a commute into the center of Manhattan 5 days a week. So seeing consistent trends with John, Nick, and Marie, and really just want to echo that.
I think it's going to be interesting to see whether that's a short-term trend or a long-term trend, because, I'm a city dweller in Chicago, and, as the economy starts to reopen, I'm really excited about going back to shows and the Cubs games and the theater and all of those other things. So I think it'll be interesting to see how many folks stay out in the suburbs and how many migrate back to the city. And I'm guessing we'll see that by 2022.
Yeah, I think in the short term, a lot of people will, cities are evolutionary byproducts since thousands of years, right? So I think cities are here to stay. So a lot of people will swing back to cities. When a few of your coworkers are at office, you want to be at office, right? Not be left out of hallway conversations. But in the medium and long term, as autonomous driving takes more and more shape and it becomes effortless to commute to work, maybe suburbs will continue to stay hot, but that's, over a 5-year, 10-year time frame.
Mm-hmm. So let's move on to our next topic, the appraisal process. Obviously, that's a key underpinning to the jumbo market. So, John, what changes in the appraisal process have you seen, and what's on the horizon for modernizing the appraisal process?
Well, thanks, Deanna, and thanks for saying it's not a hurdle in the finance process. We are doing everything we can to keep up with the crazy demand that we've seen in the lending activity. I'll tell you, very much like I mentioned earlier, there are so many things in our lives that people are going to say, well, if this worked during COVID, why can't it work now? And appraisal is absolutely one of those things. With the advent of new technologies, with the advent of alternatives to appraisals, such as waivers that the GSEs are offering, it really is reshaping a lot of the appraisal business. When we talk about what's on the horizon in the future. There's a lot of stuff that's happening right now. There certainly, of course, are a lot more things down the road. But right now, I mean, the advent of what we call modern appraisal or hybrid appraisal assignments. You know, if you think about it, appraisals have been done pretty much the same way for many, many, many years. And if you look at it and you had to create it from scratch today, one might argue, why would you spend the time sending the appraiser out to the property? You know, looking at the property and getting characteristics about the house and driving the comps, that's really not where the appraiser earns their money. The appraiser earns their money in analyzing the data, analyzing the sales information, the listing information, recognizing trends. But to help with that type of modern appraisal, you really can look at some of the increases in technology. For example, being able to use property data collectors to go out and have simulated, have models, apps on their phone that will be able to provide a digitalized floor plan along with automated gross living area calculations. You know, it's crazy. I've been an appraiser for a long time, and you would think that a home really is only one size. But if you send 10 appraisers out there, you may have 10 different answers on what that size is. So having this greater fidelity and more reliability on a consistent GLA is very important, and I think that's something we'll see. And even to take that one step further, some of the things that we were allowed to do during COVID by the GSEs with some flexibilities were even to allow homeowners to provide this same type of information that we're talking about, being able to do a scan with their phones and provide this information. And so a lot of people, I think, are used to seeing like the floor plan sketches and you know, the kind of little stick figures, and then they say the rooms and things. So one of the things when we talk about this technology is not just, okay, well, it makes it easier, but it actually can provide a much better rendition of the floor plan. So for example, I'll share my screen here real quick and show, you know, a lot of people, if you see that floor plan, that's a significant upgrade from what you see in most appraisals today. You know, not only do you show interior walls and have, you know, very definitive descriptions of appliances, locations, closets, plumbing fixtures, etc. I mean, when you are looking at an appraisal done by somebody and you see a floor plan like this, you have a lot more confidence in what you're seeing. And it's not just the simple ones. I have one more I'll show you here. A very large, complex house. And I can tell you, as many years of an appraiser, if I were to drive up to this house and see it and have my tape measure in my hand, I would run the other way, because this is a lifetime assignment here. So with that type of technology, it really facilitates being able to provide more consistent, more accurate information. And again, let the appraiser do what the appraiser is good at and be able to analyze the marketplaces and the data there.
Thank you for that. We actually got an appraisal question that I'd like to come back to in a little bit. We'll play Stump the Appraiser if we have time. But no problem. But I do have a question, Nick, for you. So, you know, what are the most popular jumbo markets that you're seeing, and what are your thoughts on forecasting home prices?
Yeah, so a lot of the work we do is focus on jumbo markets, and as you know, New York and California are the most popular ones. So, you know, all the Washington, Hawaii, and DC aren't really far behind. And you know, I created some basic graphs on, you know, how home prices have been doing. So, you know, a lot of people say that there's a massive migration out of New York and California, and that is true, right? New York has seen, not just in COVID, but years before, net negative migration since about 10 years now. The same with LA, you know, Metro, and the Bay Area has been seeing that since about 5 years. Despite that, we have seen an increase in home price indexes in all three markets. Population shrinking, home prices are increasing because wages have been increasing as well in all three markets, especially in the Bay Area. So the people who are moving out are actually lower, have lower wages, and even the people who migrate in, Google and all these technology companies and New York companies pay them much more. So wages have been increasing in all these markets, and home prices are still going up. So net negative migration has been going around for a while, and I don't think it's a major concern for now, at least. I don't think New York's the next Detroit.
Deanne, if I could real quickly, I've got a slide on some of the most popular jumbo and super jumbo markets, just to tie on to what Nick was saying.
Terrific.
Just share that real quickly here. So as you can see, you've got some of the familiar names, just like Nick was talking about. There probably aren't a whole lot of surprises there, but what we see here on the screen represented is my company's, the last 12 months, the CDA assignments that we've done, collateral desktop analysis. So performed obviously pre-funding for loans to determine the adequacy of the appraisal, but I just thought it might be interesting to see a visual of those same markets that Nick was just talking about in large degree, and how the kind of effect they've had there.
Yeah, that's a really interesting chart. Thank you for sharing that, John. It's amazing how many of those are still California markets, and with their kind of net migration to places like Dallas and Austin, it's going to be interesting to see what happens over the years with some of those.
It's another highlight of California. While 500,000 did migrate out of California net last year in 2020, the population of California is 40 million. It's 1/8 of the US population. And the net population of California still increased by 200,000 people. And domestic migration was compensated by international migration and birth rates. So yeah, a lot of people are leaving California, but the population of California is still increasing.
Yeah, great commentary, Nick. Thank you for sharing that. So on a related note, inventories are low on many markets, in many markets, as we all know, which is obviously driving up competition and prices. Marie, what do you think about whether that sales trend is going to continue?
Sure. Thank you. So inventories are low in many markets. This is a pre-COVID theme. So down 35% year over year across the country. Volumes continue to be up in aggregate in the last 3 months, ranging from up 10% to up 35, 40%. So supply definitely is constraining some markets already. MSAs that have seen the largest reduction in inventory to the tune of about 50 to 60% year over year, up until now, tend to be smaller size regions. So think of Raleigh, Akron, Boise, Provo, Utah. What is important to note here are two things, though. That smaller size cities have a harder time accommodating large net migration numbers. Two, you're working off of smaller numbers to begin with. So those percentage changes are volatile and they could be large. So for example, Zillow data shows that there are only right now about 1,200 single family homes available for sale in the entire MSA of Provo, about 3,300 in Raleigh. With that being said, home price data and comp might become less reliable as those numbers dwindle. And then sales volume, well, the dispersion there is rather wide with extremes on both ends. So using the example of these smaller MSAs, Boise and Raleigh seeing their sales count in March down by 17 and 23% respectively, in the context of large drops in inventory in that same time period, this indicates there's material supply-demand mismatch. So for those who are curious, the days on sale in March for Boise was 6 days. Raleigh was 12 days. And then on the other end of the spectrum, so talking about these two tails here, regions seeing outsized increases in sales numbers include those that have had ample supply and are just benefiting from that increased affordability driven by lower mortgage rate. And the examples there are going to be Chicago and regions in upstate New York. So, in the short run, my prediction is that assuming interest rates stay here, regions in lower cost, lower tax states will see supply continue to dwindle, and sales volumes will come in, and that will just be really exacerbated in those smaller size regions.
Great, thank you, Marie. So we've got a couple of questions that have popped up, so I'd like to read those out, and if anybody would like to jump in and answer those, that would be great. And then we'll migrate back, haha, pun intended, to a couple of the other topics that we knew we wanted to cover. So the first one is from Mark. How can the appraisal process deal with the problem of overheated property markets? Does 1004 MC actually help? Would anyone like to tackle that one?
I'll jump in as the resident appraiser here. Yeah, so great question, Mark. And let me talk about the 1004 MC real quickly and get that out of the way. You know, that's no longer required by the GSEs. It is certainly something that some appraisers and some clients require, and some appraisers really find helpful to get a handle on the marketplace. I think your bigger question is about the superheated markets. You know, the question comes down to what is market value? And when you look at the definition of market value, one of the components in that definition is a reasonable exposure time in the market. Well, if you have a listing that goes up on Friday and you have 15 offers by Saturday, is that a reasonable exposure time? In a normal market, most people would say probably not. In a superheated market, that's where the marketplace is. And if there are buyers that are lined up waiting and they are able to go in, 2 hours after a property is listed, in their mind, that may be a reasonable exposure time because that's what they're up against. So it is a it's an excellent question, and it's a very difficult one to answer when you talk about are some of these superheated bidding wars, et cetera, does that represent market value or a price above market value? And for the appraiser, obviously, what somebody is willing to buy and sell a property for is a very key component to look at. But when you're as an appraiser, you're asked to be able to provide your opinion of value based on market data, that being sales and other listings. Can you quantify that based on this activity? And that's the difficult part. But the bottom line is appraisers should be recognizing to the best of their ability and the data that they have what's going on in that marketplace and make a true, accurate reflection of that. And if that happens to support that sale price, then so be it.
Thank you, John. And then we have another question from Paul. Have you witnessed an increase in cross-collateralized SBA loans, with jumbo products? And anyone who would like to, feel free to take a shot at that one as well.
Yeah, the thing about portfolio loans are they tend to be so unique that adding a second layer of SBA component is really unique. And the loan originator is the only person who can comment on that.
Yep, agreed. So Lev, we haven't heard from you very much yet. So this next one is for you. Exterior valuations and comps. Do you think that those are enough?
Yeah, so what we're seeing is in certain circumstances, exterior evaluations and comps, can be enough. Those situations are typically those where you have fairly uniform housing stock. Maybe it's either in an HOA or a larger development where there is depth of market and you can really see recent trades. Where we would typically want to rely more on a full appraisal that has the interior inspection component is at the higher end of the market. As I imagine John can attest to, with these higher super jumbo loans, there typically are more bespoke features, and that's what a lot of the value can be ascribed to. So that's one component where we wouldn't really feel that an exterior evaluation would truly capture the full depth of the property valuation and allow you to have the finest point on your LTV. Another side to that would be where you have a property that hasn't traded as much. Maybe it's not near as many properties that are trading actively on the market. And there, what we see is that a lot of the exterior valuation based products, they're really anchored to the prior purchase price on the property or the purchase price of properties around that. So in those instances, if there have been, let's say, extensive interior renovations or other features that wouldn't necessarily be captured in an exterior valuation, those are instances where we would also feel an appraisal can help you really nail down what the value is on the property.
Thanks, Lev. Anybody else have thoughts on that they'd like to add on? No.
I would just say real quickly on that. I agree with everything Lev said. That obviously you've got more risk. You've got a larger loan with the jumbo, and you want to have as much information as possible. One thing I would say is that the scope of work that an appraiser performs in an assignment shouldn't affect the reliability of the value opinion. So if there is just an exterior appraisal, and the appraiser is able to do that and produce credible assignment results, that should be just as reliable as a full interior inspection. This is a little bit different than what we're saying. I totally agree that as your risk increases and your exposure increases, you want to have more information. But just as an aside, I think it's important because some people sometimes will say an exterior appraisal, that I'm not getting the full appraisal. I'm not getting all the information. This probably isn't as good a value opinion. And that's the point I was trying to make.
Yep, fair enough. Let's switch gears a little bit. Lumber has had quite a run up in the last few months in particular. Nick, what are you seeing in the timber market today? And if you could, dust off your crystal ball, what are your thoughts, if any, for the rest of the year?
Yeah, lumber prices have absolutely skyrocketed. So this is a graph of the last 20 years, and you can see lumber prices were stable, even though we had in the early 2000s, even though we had a huge uptick in construction. And in the last 2 years, lumber prices have just shot up like a GameStop stock price, right? And there are lots of reasons for that. Number one is a lot of people ordered lot more furniture during the pandemic itself, increasing the demand. Construction has gone up as well. A lot of new units are being built. And then there are issues with Canadian lumber and the tariffs as well that the federal government is trying to solve. And overall, it's really hard to predict where lumber prices will end up at. But in the current scenario, what I've heard anecdotally from a lot of builders is that this is causing a major issue in new supply. A lot of builders are actually canceling contracts they have with potential home buyers because they just aren't able to source lumber enough, even if they're willing to pay a higher price. So it's quite an interesting market right now, and time will tell how it turns out.
Yeah, it's really interesting. So 2 thoughts there. When I first saw that chart, the first thing I thought of was, how CNBC has their mystery chart, and then they go to the break and they tell you what company they're talking about. When I saw that, I was like, that would have been a great buy.
Yeah.
I think it's also, I'm sure you guys have seen some of the articles as well about, people that have already had new constructions that they've put down payments on, and they're waiting until it's built and they're flipping it because it's gone up so much in the time that they have been under construction. So kind of an interesting short-term trend. Hopefully things stabilize out a little bit there.
Yeah.
So let's talk about delinquent loans for a minute. Lev, I know that you work with delinquent loans on a pretty regular basis. How are you valuing these, and what trends are you seeing, particularly looking forward as some of these start to roll off their forbearance plans?
Yeah, sure. So, at Credit Suisse, we're actively financing, securitizing, and providing liquidity for a variety of delinquent loans. So, we do deal with them day to day. I'd say, the main trend that we're seeing with delinquent loans right now is there are a variety of forbearance plans that have been offered by servicers to help borrowers get on track. A lot of these forbearance plans required the borrower actively reaching out to a servicer, in some cases providing documentation, and has really shown their willingness to engage with the servicer, find a plan that works, and get back on track in a way that works for them. So I think that's a really positive sign that we've seen active engagement on the side of both the borrower and the servicers. On the servicer side, we've really seen a variety of types of plans offered to borrowers to help them get back on track, given the pandemic and the economic impact it's had throughout the country. So some of those plans are a standard forbearance, which we would view as a payment holiday. where there may be a 3 or 6 month period in which the borrower does not need to make a payment, and then there's a lump sum due at the end of that. The other side of that is, what happens exactly what you said once the borrower rolls off the forbearance plan? How can a borrower who has missed 3 payments and has shown, a willingness and a need for some sort of plan, how can they make these 4 lump sum payments after that? And on that side, we've also seen a lot of flexibility on the servicer side, offering either reduced payment plans or repayment plans where a borrower, instead of having to make the 4 lump sum payments at once, will have to make the regular monthly payment in addition to a piece of that payment, and over time they would roll current. On the other side of that, we're seeing a number of borrowers who either have a lot of equity built up over time due to the seasoning of the loan, in addition to the HPA on the property. And we've also seen borrowers who have a substantial amount of equity in the property on day one. So there really is a strong incentive on both sides to find a solution for these borrowers that works for all parties involved, either through offering flexible forbearance plans or other alternatives, given the equity that the borrowers have in the property.
You're on mute, Deanne. Hey, Deanne, I think you're on mute.
So thank you for that. I think it'll be interesting to see what happens, kind of July, August timeframe once the moratorium on foreclosure actions happens as well. Hopefully we don't see a wave coming through at that time. So before we move on to our next question, we do have a few Q&A questions that have come up that I'd like to just throw out for folks. First question is, how many appraisals are industry norm for a jumbo loan, say $1 million?
Well, I'll jump in, and then my counterparts here can add in too. I mean, I think a lot of times lenders, again, everything varies, right? I mean, we're talking about, the credit worthiness of the borrower, we're talking about the LTV, talking about everything else. I mean, somebody that's a 5-star borrower with outstanding income that's asking for a $200,000 loan on a $1.5 million property, you may not need a whole lot more than an appraisal, a single appraisal. Conversely, there are times where, particularly in the hot markets that we're talking about, that it may be a little bit harder to get a grasp on the value, particularly when you get into the jumbo loans. You start talking a lot more about buyer preference than you would just a standard, homogeneous tract type situation. So I think in those cases, it's not uncommon to get 2 appraisals. Another alternative too is some of the collateral desktop analysis reviews, as well as reconciliation reviews. There are other desktop products that can be looked at to try to come up with, to reconcile what that value may be.
Our next question is from Brad. Are we at peak HPA?
I can take that one, and then I'll let others chime in as well. So, in terms of home price appreciation, in terms of year-over-year growth, we're definitely in a 2 sigma or a 3 sigma event, right? It's a 1 in 5 in 100 or 1 in 1,000 kind of an event. But in terms of HPI, home price index, if we look at anything in the last 100 years, I don't think home price index is going to drop, for a very over a long term anytime. Land is limited. There are only 10% of homes in the country are single family homes. Population is growing, productivity is growing. And, even when the markets crashed in the past, the last 10 times, when S&P crashed more than 20%, 9 times home prices increased, right? Even when interest rates increased in the past, in the 70s and 80s, when we had a 17% mortgage, home prices increased. So I think home prices are going to increase at the 50-year average, which is a 4% a year over the long term. But the 10% a year that we are seeing this year and last year, that will slow down once supply catches up.
Mm-hmm. Thank you for that, Nick. Our last question that's open right now comes from Paul. Any comments about the GSE pilot program where a BPO replaces an appraisal? What are the unintended consequences?
I'll take first stab at it. I don't want to dominate the conversation, but you know, I'll say this: this is part of the entire appraisal modernization concept, and that is, you know, what are alternatives to what we know as a traditional appraisal? Certainly, there are many uses for products like BPOs today in servicing. We are involved with that very heavily at my company. We have a very large network of brokers that work with us. We also use brokers for our property data collections on our hybrid appraisal assignments. So there's a lot that goes on there. The only question about unintended consequences, I mean, if you talk about BPOs for originations, if we're talking about a federally regulated financial institution, the interagency appraisal and evaluation guidelines do not allow a broker price opinion for an origination. They do for servicing, but not for an origination. So whether or not that is something that, you know, the GSEs would allow outside of federally regulated financial institutions, I don't know. But I do think that it's important to recognize the main thing is independence and objectivity there. You want to make sure that a broker, you know, doesn't have an interest in a transaction, et cetera, those type of things. That's the standard type of things that appraisers certify to with each assignment.
Thank you. So one question or one topic that we haven't really covered yet, and Marie, I'd like to start with you on this one. You know, there's obviously a lot of cash on the sidelines looking for yield. Single family rentals can be a nice defensive play and a good way to diversify a portfolio. The attractiveness of this asset is somewhat muted by the foreclosure moratorium that we touched on earlier. What trends are you seeing in 2021, and any thoughts, you know, pushing it a little further out into 2022 for that rental market?
Sure. So the most notable trend this year will be cash coming in, as you mentioned, into the single family rental space. So, you know, there's been headlines since the start of the year. January, a Canadian-based pension board announced it would invest $700 million in a rental home venture with a pretty well-known institutional investor property manager who actually securitizes. In March, a pretty large, well-known German insurer announced a $300 million investment with Lennar to convert homes into rentals. The list goes on. But part of the appeal is that it's a defensive housing play. Drivers of SFR demand have really been boosted by consumer behavior in the wake of the pandemic. And so you're seeing these high retention rates to the tune of 70%, and application volumes doubling. And then, you know, we've talked about the net migration. And what's interesting is that the single family rental footprint in this country is really skewed towards away from the New York and California markets and more towards you know, the southern east regions of this country. And so those are the ones really benefiting from just changes in pace, if you will, or just migration patterns. The other side of this is that with the CDC's order of an eviction moratorium, which I believe the last I checked might be extended until year end, the space has seen higher delinquency rates. Property managers are reportedly using non-standard means to provide assistance to their tenants, and that really includes things like job training, especially for those who are in highly impacted service sectors, which as an investor, you know, just that's a win-win. So, you know, we do keep an eye on those numbers. Obviously, stimulus checks have been beneficial and go a pretty long way for those specific households. So, yeah.
Thank you. So let's do a round robin as our, kind of last official question. And then if we have time at the end, we do have one more question that's come up, but I think that's going to be potentially a little longer answer. So for our last round robin, we've talked a fair amount about housing migration in the jumbo market. Let's just kind of go around. Is there anything else that folks are seeing that you think you'd like to highlight for our participants today? And Lev, let's start with you this time.
Yeah, sure. So one trend that we're keeping a close eye on is tax policy, state by state and city by city. Given the current administration's admitted plans for changing the tax regime in some areas, we're looking at that as kind of a predictor to see where we think the next migration may be, especially in the prime jumbo and super jumbo areas. Higher income borrowers may go from certain states to others, or leave certain cities based on changes in tax policy. So that's one trend that we're looking at and keeping a close eye on for the future.
Thanks, Lev. Anyone else like to comment?
So a couple of other trends in addition to what Lev said. I think the infrastructure bill will definitely have an impact on the housing market. It will mean additional jobs, but also better infrastructure around areas that will have housing needs. And in the long term, like I said, broader trends like autonomous driving will change the nature of transit, like COVID did, and they will accelerate the pace towards suburbs as well. So suburbs of major tier 1 and tier 2 cities, I think, are here to stay and will keep growing in the roaring 20s.
All right, I love it, roaring 20s. Marie, John, any comments?
The only thing I would add is I think we're going to see, as everybody has read stories and heard about, we're going to see taking a real deep dive, performing analysis of data for possible discrimination and bias issues. I think that's, nobody's accusing people of being intentionally discriminatory, but we do think that there's some long-term leftover vestiges from data policies, from policies in the past that may still affect data today. So I think we'll see a real solid look at that.
I think that's such a great point, John. I'm even starting to hear anecdotally where that's been a focus in the residential market for a very long time, that it's starting to be a regulatory focus on the commercial side as well. So I think you're right. It's going to really be under a bright light, I think, for a while to come. Marie, any final thoughts for you on that topic? And then we'll see if we can get this last question answered before we have to say goodbye.
To add to Lev's point is, when you think about some of these municipalities that are providing things like education and just infrastructure to homeowners, you'd imagine that taxes could rise in geographies that we haven't really seen happen before. And so to his point, that is something that we are focused on as well.
Thank you. So here's the last question, and we're only going to have about a minute to answer this before we need to wrap up and turn it back to Maddie. This comes from Mark. Over the very long term, can HPA exceed the rate of appreciation of other assets?
I can take that. And then I think Mark also mentioned that, how US is lagging behind other international countries. So, I think home prices are inflation. 35% of CPI component are rent equivalent of home prices. And I was able to pull this graph while Mark asked the question. And you see, US is the black line, and it used to grow pretty quickly till about 2008. And since then, it's been lagging behind other countries that have much older homes. And even if you just do analysis of just developed countries like Canada, Norway, Australia, UK, and France, US home price appreciation is still behind them. Even though we have had a more robust economy. So, there's a lot more upside to home price appreciation, and I'm a strong believer in it.
Thank you for that, Nick. And great job as the closer today. Thank you for all of you. And with that, we're going to pass it back to Maddie. Really great conversation. Appreciate it, everyone.
Thanks, Deanne. Thanks, everyone.
Thank you,
Thank
Deanne.
you.
I hope everyone found the discussion to be of value. I'd like to thank Deanne, Nick, John, Marie, and Lev for the work that they put into this and for sharing their time and expertise with us today. Immediately following this session, we have our final panel discussion of the day, marketing and sourcing jumbo clients. Following that, please join us for either our Women in Residential Mortgages Roundtable or our California Geographic Roundtable. Thank you again to our speakers, and we hope you all have a great rest of the day.